Vanakkam, Namaskar, and hello to all the viewers and listeners to this edition of Fixed Income Markets with Sundar Mutual Fund. In no surprise to the market, as expected, the Monetary Policy Committee raised the repo rate by 50 basis points to 5.90, with standing deposit facility rate at 5.65% and marginal standing facility rate at 6.15%. CRR remained unchanged at 4.5% and MPC retained stance of focus on withdrawal of accommodation. MPC was divided in its opinion on quantum of rate hike and stance, where Dr. Ashima Goyal wanted a lesser rate hike, while as earlier Professor Jayant Verma dissented on the stance. We believe that MPC has its work cut out in form of following the developed market central banks to maintain external account stability. Further rate hikes are dependent on the future course of action in developed markets. In a clear indication, the Indian Central Bank alluded to maintaining neutral liquidity conditions by asking the banks to tap on excess SLR and SLR, excess CRR and SLR for any liquidity requirements. As expected, the liquidity has been moderating on account of negative wedge between credit and deposit, which is nearly 7%, with deposit growth at 9.5% while credit growth at 16.2% on a YOY basis. The incremental YOY deposit growth is at roughly 1,50,000 crores, while credit growth is at 11 lakh odd crores. This is almost to the tune of 9.5 lakh odd crores additional liquidity drainage in the system, which has gone into a negative liquidity zone, although the durable liquidity is still positive. The liquidity woes have further intensified on slower government spending and spot market intervention of the central bank in currency markets to supply dollars. In a check on the markets, we can compare the shape of the yield curve, both the money market bucket and longer term yield curve pre-hike cycle in Feb 2022 and now. The spread between 3-month T-bill to 1-year T-bill was 78 basis point, while it is now 72 basis point, showing some flattening in the money market curve. Similarly, on the longer end curve, the 5-year GSEC to 10-year GSEC spread was 80 basis point pre-rate hikes, while it has come down sharply to 16 basis point, showing the impact of both liquidity and rate hikes feeding into the front end of the curve in the longer term yield curve. This gives us the indication of a possible slowdown in growth in the future. Although as of now, we can see that all the growth indicators are intact and robust, namely GST collections, direct tax collection, PMI numbers in expansion zone, good pickup in the urban demand with festive season kicking in. Announcement of DA hikes also augurs well for festival season spending by consumers. Good reservoir levels also point towards a good Rabi crop and pickup in rural activity in the coming months. Only place where India needs to be careful is its trade deficit, which has been elevated despite a recent downtick, and a surprise lower CAD in the first quarter of the fiscal on stronger services exports and remittances. In the coming quarters, if the oil prices don't cool off substantially and slowdown in global large economies kick in, the CAD is likely to worsen. This will be a headwind to inflationary pressures and can result in bond yields remaining elevated. As in earlier episodes, we recommend short-term investors up to 3 months to continue using the shorter duration buckets, overnight, liquid, ultra and money market to manage their cash flows, while clients with 9 to 12 months as investment horizon can look to deploy money in active duration strategies like low duration and short duration funds. Clients with low credit risk appetite and investment horizon of 2 or more years can look to deploy in laddering strategies. Younger investors who are looking fixed income as an asset allocation strategy for retiral income can look to systematically deploy in very long duration fund. Thank you for joining. See you in the next edition.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.